Hey, so over the last 4 to 6 days, we've seen consolidation patterns forming in SPX, USO, and SOXX. The market's taking a breath before it moves. Here's what matters. When a stock tightens like this, what comes next is usually a sharp breakout with a measurable target. Right now, we've got 3 live setups. UEC just tanked 30% after earnings, and I'm going to show you whether that's your income play or an entry. We'll walk through the measured move math and how you manage risk here. I think about consolidation like a rubber band pulled down and then held steady. You know when a stock drops hard and then just pauses to catch its breath? That's your moment to pay attention. It's not random. After big moves down, stocks rest in tight ranges for a few days. That pause is the flag, and what comes next is usually a measured resumption of that downward move. That's where the money lives for us. That's where we extract real value on the trade. Here's what I see with flags, and I think you'll like how mechanical this is. You get the pull on the left, that's your original drop. Then 4 to 6 days of sideways consolidation with shrinking volume the whole way. When price breaks below that zone, that's your confirmation. Now here's my favorite part. Measure how far it fell before the pause. That exact distance projects your target on the other side. No emotion, no guessing. The math does the work for you. Look, here's the beauty of measured moves and why I love them. SPX drops 50 points, then consolidates for 5 days. When it breaks that flag, you're projecting roughly another 50-point move down. That's your target right there. Your stop sits just above the consolidation high. You know your exact risk before you pull the trigger. No guessing, no hope trading. That 2-to-1 math is literally what separates disciplined traders from the ones just getting lucky. Numbers first, always. Here's what I'm seeing right now, and I think you should pay attention. SPX is consolidating after that tech dump. That's textbook measured move setup. Energy's pausing, but the weakness underneath is real. Semiconductors got whipsawed hard, and now there's a clean flag formation sitting right there. When all 3 line up like this, it's not luck. That's regime change talking. But here's the thing, and I'll be direct with you: patience. Don't predict the breakout, wait for it. Actually see it happen before you move. Look, UEC just got hammered down 30% this month, and I get why you're watching it closely. Here's what I've learned after years of this. Massive earnings surprises often create what looks like a breakdown, but it's actually capitulation. Sometimes that's where the buyers show up and reclaim the stock. Sometimes it confirms the downtrend. I can't tell you which without more data. What I will tell you, if you're thinking about selling calls or puts on this right now, don't. The volatility is too raw and unpredictable. This is a watch, wait, and prepare to buy setup. Let it settle first. Here's how I trade this safely. Patience first. I wait for the actual breakout, then enter on that break or the retest of the range high. I size small. False breaks happen all the time. I take profit early. 60 to 70% of the measured move target is real money. I skip positions near earnings dates, and here's the key: measured moves are your map, not a promise. Markets break them. I stay ready to adapt and live to trade another day. So here's what I'm seeing. We've got consolidation building in equities over the last 4 to 6 days. Classic bear flag formation, and that sets up measured move short opportunities on SPX, USO, and SOXX if we get a clean break. Meanwhile, UEC just reported and the stock's down 30% on the month. I'm looking at whether that's an income play or an entry point for you. But here's the thing, patience wins right now. That's the takeaway. Come join us in the Discord, GG/R47RZGM.